my biggest investment ever. I put all my money into the stock market when it crashed in COVID. I thought this was an overreaction. The market's going to recover. I doubled my money in 12 months.
Thank you for joining me. If you're a beginner investor and the market just crashed, stop. Don't sell. Don't panic. Don't touch your portfolio yet. Most beginners lose money not because the market crashes, but because they react emotionally during crashes. In this video, I'm going to walk you step by step through exactly what beginner investors in the United States should do during a market crash, calmly, logically, and strategically. No hype, no fear mongering, no get rich quick nonsense. By the end of this video, you will understand why market crashes are normal, why panic selling destroys wealth, what smart investors actually do during crashes, and how beginners can come out stronger, not weaker. If you are new to investing or you've only invested during good times, this video could save you thousands of dollars in mistakes. Let's start by understanding what market crash really is. A market crash is a rapid and sharp decline in stock prices, usually driven by fear, uncertainty, or major economic events. Crashes don't happen because companies suddenly become worthless overnight. They happen because people panic. Common triggers include rising interest rates, high inflation, economic recession, banking crisis, wars or geopolitical tensions, pandemics. But here's the key point beginners must understand. Crashes are a feature of the market, not a bug. They are built into how investing works. In the year 2000 to 2002, Nasdaq lost 78%. Many thought investing was dead. 2008 financial crisis, S&P 500 dropped 57%. Banks failed. Housing collapsed. COVID crashed 2020. Market dropped 34% in weeks. Fear was extreme. 2022 bear market inflation plus rate hikes crushed growth stocks. Now, here is the most important part. Every single one of these crashes recovered. Not instantly, but historically, markets always trend upward over time. If you zoom out far enough, crashes look like temporary dips, not permanent disasters. The market doesn't reward fear, emotion, short-term thinking. It rewards patience, discipline, long-term behavior. Now let's talk about the biggest enemy during the crash, your own brain. When markets fall, your brain activates survival mode. Two dangerous biases appear. Loss aversion. Losing $1 feels twice as painful as gaining $1 feels good. Number two, recency bias. You assume what's happening now will continue forever. This leads to thoughts like, what if it keeps crashing? What if I lost everything? I should sell now and buy back later? That's how beginners lock in losses. Most people sell after prices drop, when fear is highest, near the bottom. Then they wait, miss the recovery, and re-enter after prices are already higher. This single mistake destroys long-term returns. Studies show the average investor underperforms the market because of the emotional decision, not bad investments. Emotion is expensive. Calm is profitable. Your goal during the crash is not to predict the bottom, it's to avoid catastrophic mistakes. Now let's talk about what you should actually do. Ask yourself, am I diversified? Am I 80 to 100% in one sector? Did I chase hype stocks? If your portfolio is mostly index funds, good. Mostly speculative stocks, high risk, crashes expose poor diversification. Step 2. Reaffirm your time horizon. Ask, do I need this money in the next 1 to 2 years? Or is this long-term money? If your timeline is 5 to 10 years or more, market crashes are noise, not threats. Stocks are volatile short-term, but historically reliable long-term. Step 3, dollar cost averaging. Dollar cost averaging means investing fixed amount at regular intervals, regardless of market conditions. During crashes, this becomes your secret weapon. Buy more shares when prices are low, fewer shares when prices are high. Crashes actually help disciplined investors. Step 4, rebalancing. Over time, crashes distort allocations. Example, stocks drop, bonds rise, portfolio becomes unbalanced. Rebalancing sells what went up, buys what went down. This forces buying low without emotion. Step 5, stay invested. If you miss 10 best days in the market, returns collapse. And those best days usually happen right after crashes. When fear is still high, selling means risking missing the recovery. Now, part 4, defensive moves emergency fund. Before investing aggressively, have 3 to 6 months of expenses in cash. This prevents forced selling, panic decisions, debt accumulation. Cash equals peace of mind. During turndowns, some sectors perform better. Healthcare, utilities, consumer staples. People still eat, use electricity, need medicine. These sectors add stability, not excitement. Bonds won't make you rich overnight, but they reduce volatility, smooth returns, provide balance. For beginners, stability matters more than chasing returns. Let's talk about resources. There are some recommended resources books. Number 1, The Intelligent Investor, the Little Book of Common Sense Investing. Now, some platforms to use, platforms like Vanguard, Fidelity, Schwab. Stick with boring, proven systems. Crashes are not punishments, they are tests. They test your patience, your discipline, your emotional control. Wealth is built by those who stay rational when others panic. If you're a beginner investor, remember this: you don't win by being smart during good times. You win by being calm during bad times. If this video helped you, like, subscribe, and share it with other beginner investors. This channel exists to help you avoid early losses and underperformance in the US market. I will see you in the next video. Thanks for watching.